Okay, so good afternoon to those of you just join us. My name is Guillermo Sanchez, and today I will be discussing about the fundamentals of online trading. For those of you who just joined, this webinar would be helpful for those of you who have some sort of interest in the online trading, and also for those of you who already got some knowledge but would like to understand a bit more about the basic of online trading, particularly with contract for differences as well as forex trading. So to begin with, I will be discussing with you, explaining to you, I should say, what are contract for differences, or CFDs as is also known. Then I will be showing you how, through examples, on how CFDs work. And then after that, I will be explaining to you why is leverage and margin, which are fundamental for the understanding of CFDs. Then after the first part, the webinar is done, which is this part, then I will go with this with the second part of the webinar, which be what is forex trading. Again, I will be giving you some example how to read forex pairs, as well as how to trade them as well, So I will be also showing you all that. And then at the end, if you have any sort of questions, please do ask me. You can do so on the chat box, the option, the chat, you can do so. Also, as well, if you have any questions throughout the webinar, maybe I'm going to quick or something that you didn't understand, something very specific, please feel free to also ask. And as soon as I see the questions, I will try to see if I can answer them straight away, or just wait until the end of the webinar. And I am more than happy to answer any inquiries that you may have. So what are contract for differences, or CFDs? It's basically, essentially, CFDs are an agreement between the exchange price of an asset when a contract is open and when the contract is closed. And these obviously in turn help you to speculate on the price movement of the financial market without actually owning the underlying asset. And that is something that you need to understand. It's not going to be like, for example, when you are trading physical stocks where you have like some sort of certificate showing that you actually own the stocks. In this case, with CFDs, all you're actually doing is betting or hoping that the price of that particular asset will either go up or go down, depends on your view. So let's say, for example, if you believe the price of gold will go up, then you simply buy, okay? And then obviously, if the market happens to go in the same direction, then you might close that position at a later stage. And the same will happen if you believe that the price of gold will go down, then you will sell gold in this case, okay? Also, CFDs are a derivative product. Obviously, therefore, the prices are dependent on the underlying asset to which they are linked. And you can trade CFDs with pretty much everything, with the forex, commodities, metals, indices, and also equities. Ladies and gentlemen, would like to let you know about some trading terminology, just in case, because I might say this a lot throughout the webinar. Every time I say, let's say long, I mean buy. When I say short, I mean selling. So just bear that in mind, because I try to say buy and sell, but sometimes I might just go with long or short. So just bear that in mind when I refer to these terminologies and what I actually mean, okay? So how do CFDs work? So essentially, they allow you to open a position with a small percentage in capital paid on front, and just in some sort of deposit, right? So here, as you can see here in the chart, that I took as an example the Dow Jones. Let's say that the price of the Dow Jones right now is $100. Okay, so that is actually the full value of the position. In this case, the Dow Jones. But instead of, for example, you go to the bank and you're looking to trade the Dow Jones, they would actually tell, okay, fine, we set you up the trading account, but once it's all set up and you would like to trade, in this case, the Dow Jones, obviously they will require to put $100. However, with CFDs, that's not the case because, as I mentioned before, you only have to put the percentage of your money to be able to open that $100 position. That could vary, and I will explain later on why. But in this case, let's say that you only need to put 10% of that full value. So in this case, if the value of the Dow Jones at the moment is $100, then all you have to do is to put $10 of your money to be able to trade that $100 position, okay? So as you can see, you have that big advantage of CFDs that you can trade a much larger position just by depositing a small amount, okay? And obviously, all the profit and losses will be based on that full value, okay? It will not be based on your initial deposit, so in this case, 10%. It will also be based on the full 100% of the position, in this case, $100, okay? So let's say, for example, if the price of the Dow Jones in example goes up to $101, then you have made essentially 10%, right? Because if you put $10 and it goes up $1, then you have made already $1 profit. So 10% of your total position in that case, okay? So, you know, that is one of the major advantages of CFDs. So yes, this is essentially how CFDs work, okay? Also, there could be also the case that the initial deposit might be a bit higher, might not be 10%, but it could be, I don't know, maybe 15% or 20%, or in some cases it could be lower. So let's say 5%, for example. And again, like I mentioned before, I will explain to you later on why this is the case and how also to find out what is a percentage required to open that particular position. So I hope this is all clear. Let's see if we have any questions. No questions so far. Okay, that is great. So, okay, moving on with what is leverage? So essentially, leverage enables you to increase your buying power of a particular position, as I just mentioned before with the previous example with the Dow Jones. Usually, leverage is expressed in ratio. So, for example, here at CFI Financial, once you opened an account with us, let's say a live account, we will send you a confirmation email, obviously specifying the type of your account, whether we have different type of accounts, so we will send you the confirmation of that account. So let's say the all-inclusive ones, which one is the most popular that we have, and then the next we give you the specifications, and in there we will specify what is your leverage in your account. So sometimes you might see that is 1 to 30, 1 to 500, 1 to 50, 1 to 200, so on. So I will give you an example later how you can find out how much money you need to put to trade that particular position, knowing your leverage already. But essentially, this is what leverage is. It's very important that you understand this perfectly, because again, this basically will show you how much money you need to deposit for that particular instrument. Either, as in the previous example with the Dow Jones, but also it could be with gold or any of the currencies, for example, the euro versus the US dollar. Leverage will be different in most cases. So just be careful with leverage because it's one of the major essentials of the CFDs trading, okay? And then you have also margin, which essentially the minimum amount in capital required to open a position. I know they're very similar, leverage and margin, but the main difference, obviously, margin is basically tells you how much money you actually have to put, okay, to be able to open that position, and it's usually expressed in percentage. But again, ladies and gentlemen, I would pay more attention to leverage because I find it easier, for example, to know exactly how much money I need to put once I know my leverage, okay? So I will give an example later on why once you know your leverage, it's easy to find out how much money you need to put. But just to give you some example, let's say with the previous example, just take the same one, the Dow Jones, $100. We know that our leverage is, let's say, for example, 1 to 100. Then all you have to do is get the notional value, in this case, $100, divided by your leverage, which is in this case 100, and the result of that, and obviously in this case is $1 is basically the money that you have to put in order to open that $100 position. Okay. Again, I will explain in more details this later on, but this is basically the basic of understanding leverage with margin on CFDs. So now, what are the advantages of CFDs? Well, it offers you higher leverage, which can help you to maximize your profit, since, as I mentioned before, any profit is based on the full size of the contract and not on the initial deposit, required deposit, okay, to be able to trade that position. So again, just bear in mind that it's based on the full size of the contract. Also, CFDs give you access to the major financial markets in the world, so you can trade pretty much everything from currencies all the way to commodities, indices, and also equities. Okay, so yeah, you can also trade any shares, not just in the US but also in Europe or in Asia. So obviously, this will depend on your current broker, but here at CFI Financial, you can trade pretty much a lot of stocks, okay, not just in the US, but also across the world. We offer over 5,000 instruments across all these markets. So again, it's one of the good reasons why CFI Financial has been very competitive worldwide. So, and also unlike futures and options, and also if you're based in the UK as betting, contract for differences do not have expiration date. So that means that you can hold your position as long as you want. So you want to open, for example, gold, you go long, you can have that position open as soon as you would like. So I don't know, for example, you can leave it until a few days or maybe next week or so on. So you don't need to be worried about the expiration date, like, oh my God, I need to close my position right now, and then simultaneously open up a new one. That in the case, like for example, futures an option. Okay, so that's also a good advantage of the CFDs. And the disadvantages of this, well, it's a high risk product. So obviously, you can lose all your investment. So that's another, you also, like everything in life, you have to be, everything comes with a risk. So again, you have to be careful. There are many strategies how to protect yourself with any adverse situation. Let's say the market goes against your position, and how to protect yourself when that happens. I will be actually tomorrow, same time, I will be giving some explanation about some sort of strategies, well, type of orders that help you with your risk management. So if you haven't signed up for that one, tomorrow, same time, 4 p.m. London time, I will be showing you what's actually the platform, the Metro35 platform. And in there, I will be giving you some, how to put all these type of orders that help you essentially with your risk management. So again, if you want to sign up for that one, you can go to our website, cfifinancial.com, and go where say education and analysis, select learn how to trade, and in there you should be able to find our webinars. And also we have plenty of webinars. We run webinars on a weekly basis, pretty much every day. So yes, but yeah, so as I was saying, one of the major disadvantages of CFDs is basically that you can lose all your investment, but it's not necessarily the case. Again, with risk management and very careful trading strategy, you can avoid this to happen. So that is basically it with the first part of this webinar. Just let me check if there is any questions so far. Okay, perfect. No questions. So let's carry on. So what is forex trading? Well, essentially, forex is a global decentralized market where you can trade the value of one currency versus the value of another currency. So let's say, for instance, the euro versus the US dollar. And the main reason why you would like to trade this, forex, and it's essentially for speculative purposes. Okay, that counts for about 90% of the total volumes of forex. And the other 10% is more for hedging reasons, and that is more for, let's say, corporations, companies that, I don't know, let's say a UK-based company has a supplier in Europe, let's say in Germany, and obviously in order to pay that supplier, you need euros, right? So obviously you have to go to the forex market in order to do that. But since that might be a payment that you might do later on, obviously you want to avoid yourself of any devaluation of the pound sterling, essentially against the euro. So obviously that is the reason why you have that type of strategy. But for most of us, or the rest of us, we are going to forex trading just to simply make some money. So yes, so that is basically, like I said before, counts for the vast majority of forex trading. Also, is the largest and most liquid financial market in the world, with about $6.6 trillion of daily volumes. So just to give you an idea of this, that's about 15 times, more or less, the size of the world stocks markets combined. So let's say, for example, you have probably a lot of the New York Stock Exchange, also here in Europe. So all these, Apple, Facebook, BP, and so on. You heard a lot of that on the news. Well, yeah, there are big markets. Of course there are, but compared to forex market, they are not that big. Like I mentioned before, that's about forex market is about 10 times or 15 times the size of the daily trading volumes of all the stock markets combined. So yeah, as you can see, it's pretty big. Also have the good advantages since it has a lot of liquidity. So if you like to trade at a significant size, obviously that might not happen immediately, but it will happen shorter in a shorter time than compared to, for example, you're looking to open the similar site on one of the stocks, like let's say Apple. So it might take sometimes a few hours or even days. So it depends on the size of the trade. And also another advantage of forex is that the market is open 24 hours a day, 5 days a week. And I will explain to you in the next slide why it's open 24 hours a day, from basically, well, usually it's Monday, but it depends where you're based. It could be Sunday night or afternoon. And then it goes all the way down to Friday afternoon or evening or even Saturday morning. Again, depends where you're based. And I will explain to you in the next slide why is that. And also, I will spend a little bit of time talking about the importance of the trading hours, because there will be a lot of information happening throughout these trading hours that will be able to help you with your trading strategy, and also to profit for any news that might have an impact on the instrument that you might be trading or would like to trade. So here is basically what I was saying to you, ladies and gentlemen. So basically the market, hold on. So the market opens on Monday morning, Sydney time. So obviously, if you're based in the UK or in Europe, obviously it would be then around 10 p.m. London time. That's where the market opens, and then it goes all the way. It's what we call the Asian session. And then it will still open until the end of Tokyo business hours. But obviously, by that time, it's already morning in Europe. So it's like the market, like it closes, but then opens some simultaneously. This will not have any effect on your open positions, by the way, but this is essentially how it works. And then it will carry on with all the European session. And then by the time Europe closes, obviously by that time, it's already going to be around midday in the States. So the market will continue open. And by the time the States closes, in this case, the New York session closes, but that time is already going to go the next morning in Asia. So that's how kind of the cycle goes all the way until Friday, 5 p.m. New York time, when the market actually closes. Okay, so like I said before, I do want to spend a little bit of time explaining to you the importance of this trading hour. So, for example, here with the first session, which is the Asian session, much of this session focused on the Japanese yen currency pairs. And and the reason for that is because the importance and the effect of the Japanese market has on this in the Asian market. So let's say, for example, if you have any exposure to any of the markets in Asia, so let's say an exposure with the Japanese yen, or maybe the Australian dollar, or even the New Zealand dollar, you should look out for actually any information, any data release coming out of any of these countries. And the reason for that is because in most cases, the market will be, would like to have some sort of idea what the central banks, which obviously, as you know, central banks are very important for the economy for that particular country, or in the case of Europe continent, to see where the economy is going to go, what is the economic outlook for that particular country. So yes, markets will be watching this, and I will explain to you a little bit later on in this session why it's very important. But let's say, for example, let's take Japan as for instance. You should basically look out for any speech or any information coming out from the Bank of Japan, as well as the Ministry of Finance in Japan, particularly with any information regarding to exports and imports, as well as manufacturing and trade balance. Since, as you probably know, Japan is a highly export-oriented country. Then similarly, with the Aussie dollar, or the Australian dollar, you should look out for any data release coming out from the Reserve Bank of Australia, which is a central bank over there, such as any monetary policies, as well as any changes in the interest rates, which again market will be looking at this. And the same should apply with the New Zealand dollar, any data release, essentially with monetary policy from the Reserve Bank of New Zealand. It should also be worth having a look, especially if you have any sort of exposure to that currency. Okay, so that is basically what usually happens during the Asian session. Then once the Asian session closes, we focus on the main trading session, which is Europe. This counts, just to give you an idea, accounts for about 50% of, well, more than 50% of the daily trading volumes for Forex. Okay, so obviously Asia is about 21-20%, something like that. And then the rest will also be on the New York session. So for the European session, it's pretty much the same as the Asian one, where you should keep a close look at any event that will happen during the day and also throughout the week, but especially during the European session, simply because the importance of this session has in the market. So let's say, for example, with the European Central Bank, you should watch out for any data release or any speeches from any of the official, particularly with the president of the European Central Bank. So, markets will be watching at this, and obviously, the last thing that you want is to be cut out and lose all your investment, just because simply you were distracted, you forgot about what was happening during the week. Obviously, all this could be avoided by doing a lot of trading strategies, risk management, and also if you want to find out exactly what's going to happen that particular day or the next, or during the week, or maybe next week. Here at CFI Financial, we do have something that we call economic calendar. So if you are a client, you can have access to this, and then you can also see what is actually happening, any data release that might be important, you will be able to see that because we put like a little stars and something like that. So obviously we show you the impact, where it's high impact or medium or lower. Okay, so that's also one of the good things about us. It's one of our trading tools that is including that. So yeah, so any data release coming out from the European Central Bank is important, and also I should also say any data coming out of Germany in particular, since it's the largest country in the European Union. It will also have an impact, might have an impact on the markets, particularly with the euro. Okay, especially if this data is unexpected. So, for example, for Germany, any data related to manufacturing, as well as the GDP, will also be important, and market will be having a look at that. And finally, just to sort of, carry on with the European Central Bank, any, like I mentioned before, data release or speech coming from the European Central Bank President, Christine Lagarde, will also be important, since, much of the market will be watching closely to anything that she has to say, and also anything related to monetary policy as well as interest rates. Essentially, for all these situations that we are currently living in with COVID-19, market has been very, very careful what the central bank has to say in order to, help the economy in Europe, right? So yeah. So that's why it has been very important. Maybe you might have heard or read a lot about the European Central Bank, about interest rate and so on. Not just in Europe, also in the UK, as well as the in Asia and in the United States. Okay, so yeah. So just to give some information, maybe that might be able to help you. Any announcement from the European Central Bank related to the deposit facility rate, that also is important to watch. The marginal lending facility rate as well, and also obviously the interest rate. Usually all this happen at the same time when it does happen. The European Central Bank, the president, in this case, Christine Lagarde, will be announcing all this usually the same day. So again, all this will be on the economy calendar. And then lastly, just to conclude with the any data and reports coming out of Europe, you should look for any interest rate decision on press conferences from the European Central Bank, also any speeches by any of the European Central Bank officials, and all other economic data report, to say the European Consumer Price Index or the European CPI, as well as the Producer Price Index, the PPI as well. And then also other reports, economic reports that you should look at for any industrial production reports, retail sales, and also the unemployment rate in Europe as well as in the UK as well, okay? So that's it with the European session. Then once the European session closes, well, the only session remaining is the American one. So again, this is similar to the previous two sessions. You should keep an eye on the US economic and data reports that come out throughout the New York session, essentially for any speech from the Fed or the FOMC, which is the Federal Open Market Committee, whose members are responsible for the monetary policy in the United States. And then, obviously, similar to the European Central Bank, any data report concerning the states, like the PPI, for example, the CPI, or the unemployment rate as well, that also would be important to have a look and see what the data says. So that can give you some sort of ideas of where the economy is heading. So obviously any positive one would be positive for, in this case, the US dollar. Any negative one would be the opposite for the US dollar. So again, you can take all this information and make your trading plans accordingly. Okay. So just to conclude with this part, For those of you who are interested to know what is to watch this week, well, I would say the UK GDP, which will come out tomorrow, actually, 7 a.m. London time. Also, tomorrow morning, the German unemployment rate will also be released, as well as the European CPI that also will be released tomorrow. Okay. Then as well tomorrow from the United States, we will have the ADP non-farm employment, which the market will be watching that because that will be correlated to what will happen on Friday, which is the US non-farm payrolls. This is particularly very important for the US dollar. So you have any some sort of exposure to this currency, watch out for that. That will come out on Friday around midday, 1:30 London time. Then also before that on Thursday, we have the German and also the UK PMI that's on Thursday, as well as the US, the manufacturing PMI as well. Okay, so that is essentially what is happening this week. But again, I think the market will be watching more closely is with the US non-farm payroll, which happens the first Friday of every month. Okay, so that is it with the trading hours. Let's see if there's any questions so far. Okay, nothing at the moment. Okay, perfect. That is good. So now carry on. So now, how do we trade Forex? Well, the first thing you need to watch out is for the currencies that you're going to be trading. So here in the example, as you can see, you have the first one. Let's take, for example, the euro versus the US dollar, simply because it's pretty much the most traded currency out there. Everyone trades the euro dollar or has traded the euro dollar at some point. So as you can see here, we have the euro, which in this case, the base currency, which basically base currency is important to know that because it's what the trade will be denominated by. So I will explain to you in the next slides the different contract sizes. But in this case, if we go with the largest contract size, which is 100,000 units, it would then be 100,000 euros, okay, because it's a base currency. Then we have the quote or counter currency, which in this case is US dollar. It's basically where any profit or losses will be denominated by the currency. So in this case would be the dollar. So let's say, for example, if the price goes up by 10, by 1 pip, which I will explain to you what 1 pip is in a minute. It would then be for the full contract or standard contract, which is called $10 and not euros. Okay, so similarly will happen. For example, you're looking to trade the US dollar versus Japanese yen, then the value of that would then be not $10 but 1,000 Japanese yen. So I was going into more detail in a minute. I just want to tell you basically how to read the difference between the base currency and the counter currencies. So now basically are the contract sizes for basically to trade CFD. So as you can see here on the table, we have three types of contract sizes. The first one is the largest one, which is the standard contract, which in the case of currency is 100,000 units. As I mentioned before, the units always will be based on the currency base, on the base currency, sorry. So in the previous example was obviously euros, but if you're looking to trade, for example, British pound versus US dollar, then would then be 100,000 pounds. Okay, so for the mini contract, it would then be 10,000 units, and for the micro contract, which is the smallest contract size, is 1,000 units. Okay, so then for the call, is different from the currency. So as you can see here, for one standard contract, it's 100 ounces. For the mini contract, 10 ounces, and for the micro contract, 1 ounce. Okay, and well, for the silver is for the full contract or the standard contract would then be 5,000 ounces. For the mini contract, 500, and for the micro contract, 50 ounces. And finally, as you can see here, for the oil, one standard contract is 1,000 barrels, for the mini contract 10 barrels, and for the micro contract 10 barrels. Also, ladies and gentlemen, I would suggest to memorize this table because it's essential for your trading. Okay, a lot of your trading, on CFDs, with CFDs will be based on the contract size. So again, tomorrow, as I mentioned before, I have another webinar where I will be explaining to you how to trade on the platform. In this case, the MetaTrader 5, and you will see the importance of knowing the different contract sizes because in the particular with this trading platform, it will be showing like this. Sometimes it might just be in volume, so they probably going to be 1.00, which is one standard contract, and then for the mini contract with the 0.10 and 0.01 for the micro one. So that is why it's very important to know this, because obviously there are different trading platforms, but in the case of CFI Financial, we use the MetaTrader 5. So in this case, it's very important to know this little table over here, because the last thing you want is start trading and don't really understand even the contract sizes, which is essential for CFD trading. So now, as I said before, and I was saying that, why is PIP, and know that which also is important to know. What is basically a PIP? PIP is the smallest increment in price fluctuation in currency prices. It's also 100%. And as you can see, it's basically the fourth decimal of the currency price. So when you see on the platform, you will have two prices, but before we get into that, one PIP is basically the fourth decimal. So this one number over here, so in this case, number 1. So if, let's say, for example, you look at the price of the euro versus US dollar, and the price goes up, let's say 1.2111, then it would have been 10 pips. Okay, so if it goes, this number 1 goes up to number 2, then would then be, well, the price of euro versus US dollar went up by 1 pip. Okay, so just bear that in mind that pip is the fourth decimal. Then obviously with the third decimal would then be 10 pips. 1,000 pips, it would then be the second decimal. 1,000 pips, it would then be the first decimal. Okay, but yeah, again, this is essential to know because you probably wonder, okay, perfect, I know what a pip is, so what is the value of that 1 pip? So the value of that pip will depend on your contract size. So if you are looking to trade one standard contract of the euro versus US dollar, the value of that pip would then be $10 per pip. And if you are trading a mini contract, then which is 110,000 euros, and the value of the pip value would then be $1 per pip. And if you're trading a micro contract, which is a smaller contract, as I mentioned before, it would then be 10 cents per pip. Okay, again, the denomination of the pip value will be based on the counter currencies. Okay, so your counter currencies is then in Japanese yen. In the previous example I gave you, it would not be $10 for the standard contract. It would then be 1,000 yen for that standard contract. Then it would then be 100 yen for one mini contract and 10 yen for the micro contract. Okay, so just bear that in mind when you're doing your calculation to find out, particular your how much money you're looking to make, or how much are you looking to risk. If you're looking to put one of the trading strategy, one of the other type, which is stop loss, if you want to put how many pips from that, and you want to calculate how much that is in value, just bear that in mind, okay? Because you might get very confused sometimes, especially in the beginning, about the different pip values. But just bear in mind that it's based on the counter currencies, okay? So fourth goal is basically similar or the same to the currencies. So same as currency in the way that, from the previous example, okay? as I said before, with the gold, it would definitely not change, right? So for one standard contract of gold, it would then be $10 per pip, the mini contract $1 per pip, and the micro contract 10 cents per pip, okay? With the silver, as you can see, for one standard contract, the pip value is $50 per pip. For the mini contract, $5 per pip, and for the micro contract, 50 cents per pip. And finally, for the oil, similar to gold, one standard contract is $10 per pip, mini contract $1 per pip, and for the micro contract, 10 cents per pip. So yeah, so also it would be important to know this, as I mentioned before, especially if you're looking to do, your trade strategy, risk management. It's very important to know exactly how much are you looking to. In the platform, you will have two options. One is called stop loss, which basically prevents you from losing more money. So in there, you might have some sort of strategy. Say, okay, I'm willing to risk, I don't know, $100 or $1,000 for this particular position. So obviously, you will need to know this because, obviously, once you get experience with CFD trading and forex trading, this will be easy peasy. But in the beginning, I do understand that could be very confusing because it happened to all of us. So yeah, so just bear that in mind and try to memorize it. And then once we practice, it would then be, it will not be that difficult. You will not be struggling in the beginning to find out, okay, it will be like automatically in your brain when you're talking about 100 pips or 10 pips or 50 pips, and you trade in the euro versus the US dollar, for example, automatically you will know exactly more or less how much is that in how much value is in that, okay? So that is essentially what is pip value, the pip value for different contract sizes and also the instruments. Then also very important to know, and this will be based on your trading cost most of the time. Again, it depends on the type of account that you have with different brokers, or in this case with CFI Financial. The spread is basically the difference between the bid and ask price. So the bid price essentially represents the price at which the broker is willing to buy. So in this case, the price you're gonna looking to sell. And the ask represents the price at which the broker is willing to sell. So in your case, as a trader, is buy. So as you can see here in the example that I took from the platform, you have the bid price over here and the ask price over here. So the spread is essentially the difference between this price and that price. So you can see here. Also in the platform, you already will tell you what is a spread. So in this case, we go with, for example, the euro versus US dollar, just to keep with the same example. The spread is basically 17, but just bear in mind there's not 17 pips, okay? In the case of MetaTrader, the platform that we use here at CFI, the spread is based in points. So that would then be 17 points. If you want to calculate that in pips, all you have to do is a 0 to the left. So it would then be 1.7 pips. So if you are looking to trade one standard contract of the euro versus US dollar, basically the cost of the particular trade, if it's only spread and no commission, would then be $17. Okay. So yeah, it's essentially what is a spread. Again, it would be depends on what type of trading account you have with us. But in theory, that is essentially what is a spread. It's just different between the bid and ask price. And it could also be varied. It's not really fixed. At least in our case with CFI, it's not fixed, so it could vary. So at that time when I took the screenshot, it was 17 or 1.7 pips. But it could also be lower. It could be a bit higher. That would also be depends on the current volatility for that particular instrument. Okay, and then finally, what is a swap rate or rollover? I don't know if you guys remember the beginning of this webinar that I said to you that one of the advantages of CFDs is that you can hold the position as long as you would like. Well, if you do that, in most cases, this will depend on each individual circumstances. You will have to either pay or earn any interest by holding a CFD's position overnight. And what I mean overnight is after 10 p.m. London time, or in other words, after midnight server time. If you want to find out what is the server time, you can do so if you go to your platform, and there's a window called Market Watch. As you can see here over here, Market Watch, this timing over here, that is the server time. Okay, so if you hold down position overnight, just bear that in mind that after 10 p.m. London time or midnight server time, you will either pay or earn an interest. That will depend on whether you're holding a forex a currency position, or if you are, for example, buying go long of a currency. Let's say the euro is your third. You in that case you might have earned some interest, but if you have gone short, maybe well, in the case of currencies, you will have to pay that interest. Okay, but again, this will depend on each individual circumstances. But in theory, this is what sub rate is, and it does apply to CFDs. So yeah, I just want to let you know about that as well. And then finally, before I conclude with this with today's webinar, I just want to give you a little bit of background who we are with the CFI Financial. For those of you who still don't know who we are basically, well, we were established about 16 years ago. Since then, we have been expanding our offices worldwide. At the moment, we have 6 global offices across well, the world, right? So we have one in Lebanon, obviously one here in London, in the UK. We also have our headquarters in Dubai, in UAE, and also we have another office in Jordan, in Mauritius, and also in Cyprus. And also, ladies and gentlemen, this is very important for you to know, we are fully regulated broker, okay? So whatever you open the account with us, whether it's here in London or, for example, Dubai, we are regulated. So that is very important for you to know, because, you know, you will be depositing your money with a broker, and you also want to make sure that your money is protected, you have some sort of protection. Okay, obviously this will vary across different financial regulators, but it's very important to note that, you know, that your broker is regulated. So in the case of CFI Financial, we are fully regulated company. Okay. And this is the different type of regulation that we have. So as I mentioned before, here in London, we are regulated by the FCA, which is a Financial Conduct Authority. In Lebanon, we are regulated by the Bank du Liban. In Dubai, we are regulated by the DFSA, which is the Dubai Financial Services Authority. In Jordan, we are regulated by the Jordan Securities Commission. In Cyprus, we are regulated by SISEC, and in Mauritius, we are regulated by the FSC Mauritius. Okay. And also, well, like I mentioned earlier on, we have over 5,000 instruments to trade, so that go across, you know, futures and options, also shares, forex, commodities, metals, oil, and so on. Okay, so you can see all that on our platform. And why choose CFI? Well, we offer a very high competitive rates, in this case spreads or type of account. You also have a leverage up to 1 to 30 for if you are a retail client, but if you qualify as a professional client, we can give you up to 1 to 400. Obviously, this is in the UK. It might be different from other offices, entities, but here in the UK, you can get up to 1 to 400. You qualify as a professional client. Otherwise, it would be 1 to 30. Spreads, it could be as low as 0.0. Again, would depend what type of trading account that you have with us. Also, we offer a fast execution, deep liquidity, and also we have 24 hours, 5 days a week customer service. So if you have any questions, we're always going to be there for you. And finally, if you don't follow us on social media, please do, since we are constantly updating our, you know, the service that we're currently offering. And so every time we add in more instruments and more offering that, you know, we're currently having. So yeah, if you want to keep updated with any of our services, please do follow us on social media. We have a Facebook page, Instagram, LinkedIn, Twitter, and also we have a YouTube channel where we're constantly posting videos about trading. So if you want to find out more about trading, something that we didn't discuss today, you can go to our YouTube website or channel, and then you can find out all the videos over there. And also, if you have any questions and you would like to contact me directly, you can do so by either calling the office and asking for my name, or you can drop me an email at g.sanchez@cfifinancial.com. And with that, ladies and gentlemen, I conclude with today's webinar. If you have any questions, please do so before we end the webinar. Perfect. Well, so far there's no questions. So if you happen to have any questions later on, you can always contact us, and we'll be more than happy to help you with any questions that you may have. Okay, perfect. Well, once again, it has been a pleasure. I hope you all have a lovely afternoon. And for those of you who are into football, enjoy the Euros and see you next time. Goodbye.